Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Canada's trade deficit widened by more than expected in November. Data from StatsCan showing the country had a trade shortfall of $2.2 billion, with total exports falling 2.8%. Shipments of metal and non-metallic mineral products posted the largest decrease, and both exports and imports of motor vehicles and parts saw a decline. Gold has been the most significant contributor to the fluctuations in exports, with large shipment declines to the UK, US, and Hong Kong. Shares of Rogers Communications are moving higher. They're up about 3.5% right now. That after revenue and profit in the latest quarter topped Bay Street estimates. The results were helped by the telecoms investments in the Canadian sports industry, essentially the Toronto Blue Jays in their run to the World Series. Oh, so close. Now, for the full year, Rogers is projecting revenue growth of up to 5%. Celestica shares are taking a hit, a big hit, more than 17% right now. Analysts are highlighting the company's increased capital spending as well as its disappointing full-year outlook. Celestica is boosting its planned capital investments to $1 billion for the year. On the upside, revenue and profit in the fourth quarter beat expectations, and there was an increase in revenue driven by continued demand for AI data center technologies. And turning to the markets now, the TSX still struggling today, off by more than a percentage point. Not much better. In fact, it's worse in some spots down south of the border. Taking a look at those numbers. Yeah, the S&P 500 off by 0.95, the Dow by a half. The Nasdaq's, I want to say bounce back. That's probably not the best word. It was off by more than 2% at one point. Now it's off by about 1.6. All right, let's take a look at what is trending today when it comes to leaders. First up, First Quantum Minerals. It's up, and it's set to seek a buyer for its Turkish copper mine. And you can see it's up by 1.73% today. Now, the laggards, Open Text, is what's struggling right now. Yeah, it is off by 4.5%. It names a new CEO, and Vizsla Silver shares there. Look at this. Off by as much as, and it's improved a little, but it was off by as much as 17%, the most since 2020, after the Canadian miner reported that 10 people were taken from its Panuco project in the Sinaloa state in Mexico. Well, Canadian food conglomerate Empire says it will shut down a Sobeys fulfillment center in Calgary. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, what's the latest on this?
Yeah, so the latest now, well, we're watching Empire shares rising today. So apparently good news. It was up about more than 8% in the pre-market. Now it's still up. So even though they're shutting down a warehouse, this seems to be working well for Empire, which is the parent company of Sobeys. So what we're talking about here is a warehouse based out of Calgary for their grocery delivery business. Voila. We've seen the trucks around here. But apparently sales at West have not been doing that well. And so that's why Empire made this decision to close the warehouse in Calgary. There's another small one in Edmonton that's going to be closed as well. And then there was construction of one in Vancouver that's actually paused as well because of the sales out west compared to Ontario and Quebec, which is also where Voila operates. Now, Empire says it will be taking a $750 million write-down on the business because of this. It says the results of this online grocery expansion just did not meet the company's financial expectations. So you win some, you lose some. They were trying to kind of branch out and see how many people would actually order their groceries online, and it seems as though for every grocery store, it seems as though really that money is still on foot traffic and people actually going into stores to buy their groceries. But at the same time, Voila is still going to be operating in Quebec and Ontario.
So they're still going to run here. Any indicators how long they might run here, and also Did they say why people were not coming back in? What was driving them away?
There's no indicators that anything's going to change for Ontario and Quebec. Like the company's saying that sales here are really, really good, that they're happy with how Vola is operating in Ontario and Quebec. They've also partnered recently with DoorDash. And so they're going to start, if you live out west, you're going to start seeing those services with Sobeys and DoorDash. They also have third-party partnerships with Uber Eats. So there's still things that people out west can use if they want to shop at Sobeys online. But in terms of why this didn't work out, it's not really clear, right? Like there could be a number of different factors. There's a different population out west in Calgary, for example, than there is here in Toronto. And also COVID. This all started, and that warehouse in Calgary was built about 3 years ago. It opened about 3 years ago in the midst of COVID when people weren't going out as much. And so maybe ordering more of their groceries online. So that could have been one of the reasons now people are feeling comfortable going and shopping again. But according to JP Morgan, this Sobeys closure will have a limited financial impact. JP Morgan also saying they see limited risk in terms of further closures with Sobeys. So for Ontario, Quebec, it seems as though Voila is doing well.
Business as usual.
Business as usual.
All right, Lindsay, thank you for that.
Thanks.
BNN Bloomberg's Lindsay Biscaya. Coming up, the fixed income market may need a new strategy for the new year. We'll take a closer look after the break. Well, after yesterday's Bank of Canada decision to hold rates, the outlook for fixed income returns continues to tighten. Our next guest says the old set it and forget it approach may no longer cut it and that investors will need a new strategy heading into 2026. To break it all down, we're joined now by Adrienne Young, Director of Credit Research at Franklin Templeton Canada. Adrienne, thank you very much for joining us. Since it's no longer set it and forget it, is it set it and check it every day?
Yeah. It's set it and check it obsessively. This is a market that I think will really reward active investors who are able to look around the world, outside Canada, where we are looking at maybe slow growth, some more difficult market dynamics, especially for consumer-related bonds. Everything is very tight right now. Mm-hmm. All corporate credit is very expensive. So you really do have to be doing your homework and looking for opportunities that are liquid, that are relatively high quality. High yield is very expensive right now. And you have to be willing to take advantage. We think the market is perhaps a little toppy at this point. Yields have been very attractive for the last couple of years. Mm-hmm. And that has drawn a lot of demand, a lot of new investors into the market. They have overwhelmed supply to a certain extent, which has driven price of bonds up. We think that is going to reverse in the relatively near term. That's a function of government spending, government bond issuance, corporate bond issuance, especially in the tech sector and utilities because of AI spend. When that reverses, you really want to be able to take advantage of that widening in spreads, which is why we focus right now on buying best quality credit, on buying highly liquid names so that we can use that as a source of funds when the market permits us to go in and buy the good stuff on sale.
So define like a best quality and also highly liquid. What and a couple of examples to you?
Well, the classic example in Canada would be a Canadian bank senior bail-in bond. Another really nice example, we like this sector a lot, is what is called an FABN. That's a funding agreement backed note. That's a secured bond issued by a U.S. typically insurance company, and they're usually rated AA as compared to Canadian bank senior notes, which are rated single A, and you get just about the same spread. So we love those. They're in the index. Everybody knows them. Everybody understands them, which makes them more liquid, and that's valuable.
And when you start looking for for deals, when any indicator when we might be seeing that? I mean, we've heard from both the Bank of Canada. We may see cuts down in the States, but they may go up here. What are you going to be looking for to give you that idea to get back in?
Well, we're looking for spreads to get wider than they are now. Obviously, they are at heights that we have not seen since the great financial crisis at this point. It doesn't matter how you slice it and dice it. The spreads are just very tight in Canada and the United States. What we're waiting for, well, first of all, of course, there's geopolitical risk. We don't know when those headlines hit. We don't know which headlines will affect Canadian credit. One probable source of a little bit of volatility will be CUSMA negotiations, which are coming up this summer. When I talked about supply, another possible source of widening would be supply coming out of the tech sector. As U.S. spreads widen, Canadian spreads usually widen with them. And one source of U.S. spread widening in the relatively near term would be issuance from the tech sector. Those issuers are in the middle of earnings season. They're going to be reporting very soon. Once they've reported, they'll begin to issue.
And what kind of time horizons are we looking at? Or should you be maybe looking for a blend?
Weeks for tech sector issuance. CUSMA headlines, your guess is as good as mine. But also just with the credit curve, longer duration, you're in one of your notes, you're talking maybe 4 to 7 years, you're thinking is a sweet spot right now? Yes. For a little while, the Canadian credit curve, like the U.S. credit curve, was inverted. That was, call it 2023 to early 24. And then the Bank of Canada started to raise rates, and our curve is no longer inverted. While it was inverted, for a lot of investors, it really was set it and forget it. Buy 5-year GIC, lock in 6%. How wonderful is that? You really don't have to think about it. You can't do that anymore. When you look to refinance your GIC right now, you're getting just a little over 3%. That's not really very appealing. So we think that the sweet spot is in the 4 to 7 year range because the Canadian curve is now positively sloped. You are paid to add duration. But we also have investors who prefer a much smoother ride, who are really focused on capital preservation. And for those folks, there are alternatives to GICs. You can look at, for example, Franklin's ultra short fund, which does essentially the same job, takes very little duration risk, and it's liquid, unlike a GIC.
We'll have to wrap it up there, Adrienne. I apologize, Adrienne. We're running out of time, but thank you very much for joining us.
Thank you.
Adrienne Young is Director of Credit Research at Franklin Templeton Canada. Coming up, we'll take a closer look at Microsoft's latest earnings after this. Shares of Microsoft are under pressure despite beating Wall Street estimates on their third quarter revenue. For more on this, we were joined earlier by Rishi Jaluria, IT equity research analyst at RBC Capital Markets.
I think we took a step back. This was a solid earnings report. If you had told me that Microsoft would be trading at 22 times GAAP earnings and maybe lower than that with today's pullback, and put up a quarter like this, I would have thought the stock would be up. Now, I think there's two things that maybe are weighing on investors here. Number one, the Azure growth in the quarter was, I thought, solid, but maybe it was a little bit light of what people expected, and it did show a point of decel. Now, they remain capacity constrained, and they definitely signaled that overall Azure growth would have been meaningfully higher if they were actually at parity. And then the second thing is now they're talking about raising CapEx, right? Because, well, how do you get out of being capacity constrained? You have to build more. And so the CapEx numbers are going higher. And I think as we've seen in this market, investors don't particularly care for that mismatch between we have to invest now and the revenue will take time to actually be generated. But I can't really think this is creating a good buying opportunity for us.
It's really amazing. I mean, Azure posting a 38% revenue increase during the quarter. Investors really are looking for exponential increases here, aren't they, in business?
I think that's right. I think with everything going on AI and all the spending, investors are looking for accelerating growth. And in this environment, let's take a step back. That's $9 billion of Azure ARR added sequentially. That is a really high number, especially when you're capacity constrained. But I think in this sort of market, it just tends to be very one number or very short-term focused. And again, I think for those of us that are willing to be long-term investors and think through the long-term TAM opportunities, you can look through the noise and there's a lot more to like in the earnings report.
They are pretty involved with OpenAI. Is that a worry? Because there's been concerns about OpenAI's debt and heavy spending, for example.
Yeah, look, I think there's two pieces here that I think are really important. So number one is they did tell us in a new disclosure that OpenAI represents about 45% of commercial RPO, and RPO being kind of a good measure for future backlog, future revenue to be recognized. But they also are not including all of OpenAI in there. They're effectively saying, look, we're risk adjusting this, and the longer the duration, the more kind of risk adjustments they're making. So I think they're being pretty conservative with what they are including in that backlog number. Well, the second thing, which I don't think is super well understood by the market, is all of these applications that, by the way, they're showing some really good signs of early traction with, be it Office Copilot, GitHub Copilot, Security Copilot, Dynamics, et cetera. All of these AI applications are built in a modular manner that is not entirely dependent on OpenAI. In fact, you can use Anthropic models under the hood. You can use open source models, be it Llama or Mistral. And so as a result of that, Microsoft's fortunes are not entirely dependent on OpenAI. Obviously, they have kind of a good situation with OpenAI where they have research rights till 2028, IP rights till 2032, exclusivity of the OpenAI API. But their future fortunes are not dependent on OpenAI. That if OpenAI doesn't quite do as well, and by the way, with all the noise around the model provider, they're still one of the cutting edge frontier model providers along with Anthropic and Google. But if they really just don't go to the level that I think people want them to, Microsoft can still succeed.
I'm not sure if you saw this story. I think it's only Forbes are reporting it right now. OpenAI is supposed to be working on a new social network that will only allow people on board using biometric identification. Bots can't get in on the act.
Yeah, no, look, it's interesting stuff. I think one thing that maybe differentiates OpenAI as a company is they're making a lot of very big bets in every area, right? They are not only a model provider. They're trying to build, domain-specific agents. They're getting into healthcare. They're talking about consumer applications. Now you have, social media. There's, they're talking about getting into the advertising game. They're making a lot of very, very, very big bets. And, candidly, if this is a company that aspires to be the largest company it can be, you need to make all those big bets. Some of them may pay off. Some of them may not. Some of them may have mixed success. In many ways, it kind of reminds me of Microsoft, right? Microsoft did get into social media. They bought LinkedIn and they made LinkedIn a much bigger asset than it could have been. They're obviously huge in enterprise software. They're in infrastructure. They're in security. They're in developers. They're in gaming. They're in search, right? I mean, very few of us use Bing, but it's actually a huge, huge business. So, it kind of reminds me of that in a certain way. And, look, I think it brings up a good point that as we have to figure out how do we differentiate what is actually AI versus what is human, and that line is getting blurrier and blurrier by the day. Ways of having verified content, verified actors, I think will become increasingly important.
And you would be a buyer of Meta right now, of Microsoft, I beg your pardon, and your target $640 US?
I think so. Look, I think I would take huge advantage of this pullback. The market seems like it's being candidly pretty irrational on Microsoft right now. Lots to like out of the quarter, strong Azure number. And again, they're being, I think, conservative with a lot of their stuff. And then you saw really good success out of Microsoft Fabric, hitting $2 billion of ARR less than 2 years after being introduced onto the market. Good signs of early traction with M365 Copilot. GitHub Copilot remains strong. I think there's a lot to like here. By the way, they're preserving margins in spite of all of this spending. And to get that at 22 times GAAP earnings, this candidly seems like a gift to me.
Andy was speaking with Rishi Jaluria, IT equity research analyst at RBC Capital Markets. Well, Canada continues to be open to a deal to bring news back to Meta's platforms, including Facebook and Instagram. CTV's Mike Couture has more.
Like many local newspaper editors in Canada, Charlie Senak's job got a lot harder when Meta stopped allowing news on platforms like Facebook and Instagram.
I hear it from our readers, too, who are incredibly frustrated that they can't find us on Facebook.
But now the federal government and Meta are talking about fixing that. The Online News Act and Online Streaming Act have been called irritants by the Trump administration in trade discussions. Both laws compel U.S. tech giants to financially support Canadian TV, film, and music sectors. Instead of paying media companies for carrying their content, all Meta platforms blocked Canadian news on sites like Facebook and Instagram in 2023. In response to the renewed talks, Meta pointed media to these comments in October.
News publishers place their content on our platforms because they get increased distribution, and then they can monetize the clicks that they receive as a result of that distribution.
Curran added that Meta was hopeful news could return to their platform. The Identity and Culture Minister says talks are preliminary.
Canada's door has always been open to have those discussions. We stand by the value of the two acts that make sure that platforms are doing their jobs and making sure people are getting fair dealings.
But even that is welcome news for CNAC.
If this does happen and we can post on Meta again, I think we'll be at a point where we can really start growing in even more ways than we already have, and with the added advantage of all the work that we've already put into it.
Last year, the Canadian government removed the digital services tax just to restart talks with the U.S. But it's unclear how far it's willing to bend with the Online News and Streaming Acts.
With CTV's Mike Couture. Coming up, Lockheed Martin raises its expectations for 2026. We'll explore why. Shares of Vizsla Silver are falling sharply after the Canadian mining firm said 10 individuals have been taken from its project in Mexico. The incident is currently under investigation, and Vizsla says its crisis management and security response teams are actively engaged. Some activities at and near the site have been temporarily suspended as a precaution. Shares of Canadian Pacific Kansas City are edging higher today. The rail company posted higher overall revenue in its most recent quarter and also saw non-freight revenue surge 26%, beating estimates. On the downside, CPKC says the ongoing tariff war costed $200 million US over the past year, but it was still able to control costs amidst a challenging market of macroeconomic and trade policy headwinds. Tesla shares also seeing some pressure. The EV maker reported a 61% drop in annual profit and also saw revenue slip compared to the year before. Tesla has been dealing with growing competition and has cut prices in a bid to boost sales. The profit decline marks the second straight drop for the company. Tesla is now leaning heavily on bets in AI and robo-taxis to drive future growth. Shares of Comcast are trading slightly higher right now, still down for the year. That's after the U.S. media giant beat profit estimates in its latest quarter and logged higher revenue. The company's Peacock streaming service also saw 44 million paid subscribers and a 23% jump in revenue. Comcast also added mobile subscribers through bundles, which helped offset losses in cable TV and internet customers. Well, Lockheed Martin has seen its stock soar after the company raised its 2026 outlook in recent earnings reports. The defense giant is just coming off a 7-year deal with the U.S. Department of War and announced a separate agreement today to boost production of its THAAD missile interceptors. To break this down for us, we're joined by Christine Liwag, Managing Director at Morgan Stanley. Christine, thank you very much for joining us today.
Thanks for having me, Roger.
A good day for Lockheed right now. What are the key points to this today? What has them rising so quickly?
The key points are, you highlighted it already, the PAC-3 missile announcement earlier this month, where they can triple production in 7 years. And this morning, the THAAD missile interceptor with a 4 times growth through 2020, through the next 7 years. These are landmark agreements, multi-year in nature, that significantly expands capacity. And Roger, what this really reflects is ultimately a heightened geopolitical environment that provides U.S. defense tailwinds. And now that the Department of War is focusing on expanding capacity, you're starting to see more of these announcements come through to the industry, and it's starting to flow through the bottom line for Lockheed Martin. And so for context, in the quarter, they reported a record backlog of $194 billion.
Wow.
This is quite a lot.
It is. And are there indicators that this could just be the start, that they may see these deals get even bigger?
And yes, and this is why there's so much more interest in U.S. defense in general. On top of this record backlog, their 2026 outlook, they introduced this today, provides 5% top line growth. But if you look at the 2026 budget request, that provides 20% growth in modernization. This is the procurement and RDT&E spending for hardware for the U.S. government. That's 20%. And the president talked about a $1.5 trillion request for fiscal year 27. That would be a 50% increase versus fiscal year 26. It really seems like we are in a very different era of growth that could accelerate from here.
And so it sounds like its revenue outlook, they raised it to between $77.5 and $80 billion. Sounds achievable.
Achievable, and also historically, defense primes provide fairly conservative outlook in the beginning of the year, providing room for increases throughout the year. So this is a very conservative approach, and with the record backlog, the key variable for them in executing this revenue target would be the supply chain and ability to get product out the door.
All right, we're talking about the missile interceptors. Any other sections where they saw some good numbers and any areas of concern?
It's all about the entire portfolio, Roger. Aeronautics, missile fire control, everything is growing really well. Space, all around the product segment, everything's growing. And by the way, this is also for the rest of the defense industry. We're seeing this too for the portfolios of Northrop Grumman, L3 Harris, RTX. We're seeing strong, unprecedented demand in modern history for a lot of these products to fulfill the generational investments that the U.S. military needs to make for preparation for the future.
Okay, and what is Lockheed Martin doing right? I mean, they're apparently doing a lot of things right, but what are some of the things that makes them so enticing?
Right now, what makes them really enticing is getting these landmark agreements where you're getting the government to support multi-year procurement programs. Some of the challenges in increasing capacity has been the uncertainty in the budget environment and not getting the funding right, or you have strong demand signals from the customer, but not necessarily a firm contract. And so that makes it difficult for government contractors to then invest capacity because you're not sure if these will actually materialize, even if the government's saying that they want it, but there's no firm contract. So giving them a 7-year outlook and being able to commit to a 3x capacity growth for the PAC-3 missiles, a 4x capacity growth for the THAAD, these are what Lockheed's doing right, and this is their agreement that they have. Now, again, the PAC-3 was the first of its kind, very landmark. The THAAD follows up on that. And also the U.S. government has landmark agreements with L3 Harris on missile and fire control business as well. So the question is going to be, is this the beginning for the rest of the industry? And this is part of the reform that the Department of War war has created on acquisitions to accelerate and expand capacity to meet what it needs. And that's the reason for that is all these companies have record backlog and backlogs that are up 20, 30, 40% versus where they were 3 years ago. But top line for the most part have been low single digit. And the reason for that is their inability to have the same output because of supply chain constraints or capacity constraints. So this is the government really saying, we want these things, and here are some agreements, contracts, assurances, so you can expand out these capacity and spend the money today.
Now, everything sounds wonderful, 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 but any potential headwinds that could derail all this?
The headwind is going to be the budget environment. So even today, the fiscal year 26 budget is not a done deal. The path to get to a $1.5 trillion in fiscal year 27 is still nebulous. So we need to get the budgets passed, and these budgets will then support these contracts. But ultimately, what's positive for the sector is you're seeing indication that this is a priority for the administration. They're changing policy, they're changing acquisitions, they're changing these contracts, and they're awarding them. And that's why you're seeing some of these defense companies break out of the historical range the past few years when we didn't see this much of a priority on these contract awards.
And could a change of government at any level have an impact on this, either in the House with the midterms coming up or change of the presidency in 3 years? Could that have an impact on any of this?
We still have to live through the year in 2026. And also from there, we have to see the dynamicism in geopolitics. And so, and underlying all of this actually is if you look at a PPP adjusted basis, China, Russia, and Iran spent more on the military than the US starting 2023. And that is a pretty big dynamic about a potential catch up that the US would have to do. And if you look at 24 numbers, the gap actually widened in terms of how much these countries are spending versus the US and the military. So going forward, the question is, what is the dynamic event in geopolitics? Do you see acceleration of spend in other countries? And if so, that may not make the US priority change as we respond to these environments.
Okay, we'll have to wrap it up there, Christine, but thank you very much for joining us.
Take care. Thanks, Roger.
Christine Liwag is Managing Director at Morgan Stanley. Well, the breakout hockey drama Heated Rivalry sparked a frenzy over a Team Canada fleece, and now Canada Forward brand is turning that viral moment into real merchandise. More on that next. The hit series Heated Rivalry has become a cultural moment, and nothing symbolizing it more than the now viral Team Canada fleece. To meet fan demand, producers have partnered with Province of Canada, a Toronto label that champions locally made Canada First clothing. The brand's co-founder, Julie Brown, joins us now. Julie, thanks very much for joining us.
Hi, thanks so much for having me.
Let's talk a little bit about how you connected with the show and how this came together.
Yeah. So, I mean, we kind of followed along the conversation that was happening online and decided to put together a post as our way of raising our hand to say, hey, we'd love to make this in Canada. We also reached out to the costume designer, Hannah, and then she put us in touch with the producer. And again, there had been a lot of fans mentioning us and wanting it to be made in Canada. And so we finally spoke to the producers. They also wanted to make it in Canada, so we were really aligned on that, and that's kind of where things, led, and here we are.
And what kind of challenges are there to try and get something from a TV show into the market and staying Canadian at the same time, which is very important to you by the sounds of it? Yeah,
for sure. We've been making our products in Canada for the last over 10 years now, so that's definitely our main goal here. We did have the fleece in our possession for a short period of time. And we are going to try and, make it as close as possible because we know that that's what the fans want and that's our goal as well. And it's a challenge, but one we're up for, I think.
And what is it like? I mean, you want it to be Canadian made. You do everything. All your products are Canadian made. Have you found it easier in the last little while with everything that's unfolding south of the border? Has it gotten harder to try and find Canadian sources for making products and manufacturing products?
I mean, the partners we've been working with for the last 10 years. So these aren't new relationships. We do knit a lot of our fabric here. And sometimes if we can't make that fabric in Canada, then we do bring it in. But yeah, we plan to make this with partners that we already work with. And yeah.
Have you noticed an increase in demand over the last little while because of everything that's going on with the U.S.?
Yes, absolutely. I mean, last year was an amazing year for us, and Canadians have definitely, are putting their dollars towards Canadian-made products, and we have felt that in a huge way. And obviously, over the past 24 hours, 48 hours, it's been pretty wild over here.
And I imagine, it's a challenge because, I mean, price point, you can't come close to competing with products that are made in Asia and things like that, I imagine. But the quality you can, and you can beat it easily. How much of a dedication does it take from your customers to buy? I mean, to stay with you, because there must be a larger price point for them.
For sure, we are slightly higher than some of our competitors, but I think overall margins make a big difference. I think a lot of larger companies have much larger margins than we do, and we're comfortable with that. We're able to run our business and still with those margins. And I do think that customers come to us for the value that we provide. Yes, it's a little bit higher in price, but our products do last longer, and we always make sure that it's at a price point that people can find value in it.
And that has to be a challenge for you, though, to keep that price point. When you say it's a little bit more, I would have thought it would be a lot more. So when you're saying that, it must be a challenge for you to find the companies that you can work with and keep the price within range.
It can be challenging. That said, I do think that people would be shocked at the margins that a lot of larger companies have in comparison to us, and so. Again, I think we're still very competitive when you look at the quality of our products. All of our products, we usually try and use natural fiber, so we use cotton a lot. And so the value you're getting, if you really compared it to apples, we're not actually that much higher than what's out there and what's in the market.
And now,
I think a lot of things are, synthetics and blends, and so in order to reduce the price for people.
But you're offering all cotton and that quality with it. And what's it like? Were you shipping to the U.S. before, and are you shipping now?
We were up until September or August, or late August. Obviously, it's been very difficult with the de minimis removal. There's just a lot of additional paperwork for us to do, and because we also qualify for CUSMA, that adds another layer. So it's not like there's even duties for the customer to pay. So it's a little more complicated because of that. So we have paused it at the moment, but we are working on that, and we plan to have it in place for the launch of the fleece.
Yeah, I was looking at the numbers for Heated Rivalry South of the Border. There's about 8 million people watching it south of the border regularly each episode. So there's a potential good audience down there for you. And a little Canadian good-heartedness.
Canadian fleece.
All right, and when do you hope to have this all set to get together and ready to start shipping them?
Yeah, we don't have a date just yet. Keep in mind this announcement, this just came to be. So I mean, we are moving quickly on this. I know the fans want it yesterday, and we do too. So we're doing all we can to get it out and at least make it available for pre-order as soon as possible.
All right, and are you a fan of the show, and do you watch it?
I have. It's hit. I think it's been amazing over the past few days. We've had a lot of people reach out in other countries and friends of the brand and personal friends. And I think obviously it's about a lot more than hockey, and it's an important show to a lot of people and in the sports world for sure. And so we're just, we're grateful to be part of that. I think that it's an important story to be told.
Yeah, and hopefully it starts some conversations. And we're out of time for our conversation, but Julie, thank you very much for joining us.
Thank you for having me.
Julie Brown is co-founder of Province of Canada. Still ahead, today's Market Movers with Bloomberg's Matthew Griffin. Time to take a look at some movers south of the border, and we're joined by Bloomberg's equities reporter, Matthew Griffin. Matthew, always a pleasure to have you here, sir. I wouldn't want to be at the Microsoft offices right now, though.
No, Microsoft, Roger, is heading, as of now, as of our last numbers, towards the second worst stock market wipeout in one day of all time. The only company that has ever lost more than the about $400 billion that Microsoft is on track to wipe out today is NVIDIA. About a year ago, when DeepSeek, the open source AI model, raised concerns about AI spending, and AI spending concerns surfacing again for Microsoft, this company said that they spent $37.5 billion on capital expenditures in their fiscal second quarter. That's a 66% increase from a year earlier. This comes as big tech companies just spend tens of billions of dollars on building out their AI capacities. At the same time, they reported slightly slowing growth from the prior quarter in their Azure cloud business, which maybe goes to show that the concern isn't just the spending, it's also about the payoff and about how you pay for it. Meta reported or gave a forecast that shows really high AI spending, but their revenue is also really strong. That has the stock jumping today. Microsoft, the risk-reward balance, as investors see it, just isn't there, again, contributing to a huge wipeout for the stock.
Now, NVIDIA has bounced back, though, I think, since then, right? If I'm not mistaken, I'm just looking at the graph for the last year. So maybe Microsoft, I'm sure, will recover from this at some point.
Absolutely. The DeepSeek concerns turned out to be somewhat short-lived. You also had tariffs, things like that, but NVIDIA's stock eventually did recover. And this idea that we will need huge spending on AI, spending that flows in large part to NVIDIA, has not faltered. So yes, it's absolutely possible this narrative will change again. But for now, investors are fleeing Microsoft stock, and that's dragging down the broader market. You've got software stocks and other tech names leading a retreat.
All right. Are we in the golden age for airlines again? Southwest Air having a good earnings report.
Yes, Southwest forecast profit of more than $4 per share U.S. on an adjusted basis this year. That analysts were only looking for $3.20. That has the airline stock up about 17% today, trading at levels not seen since 2022. I would say, though, that this may be more of a company-specific story than an industry story. Air travel demand is absolutely strong, but Southwest has been a bit of a laggard. They've been under pressure from Elliott, the activist investor, to raise their profits, and they've been doing things that are now paying off, like charging for premium options, more leg room, charging for checked bags, that kind of thing. Famously, they've abandoned the free-for-all seating model. They've got assigned seats. So it's sort of a story of them catching up with peers and enjoying some of the same strength.
All right, and last one we want to get to here. Caterpillar, I love saying this, it's rising on its continued AI strength, which makes me sound like they're going to get rid of giant bulldozers and things and use AI for them, which it won't happen. I rambled there for a second. Go ahead, Matt.
Well, yes, Caterpillar, obviously known for its bulldozers and backhoes, but their biggest business segment by sales now is actually their power and energy segment. They sell a range of products, but the generators used by data centers have been the subject of investor attention. That business segment reported 25% profit growth in the first quarter. That helped the company on the whole top analyst estimates, and it has the stock rising today after a 65% rally over the last 12 months. Just continued strength there. Even in the face of some headwinds, the company is still facing some pretty steep costs due to tariffs. That's hitting their margins, hitting their operating profit. But right now, as analysts look for AI exposure, even on a day when some AI names are in the red, like we've talked about, they're just seeing dollar signs when it comes to Caterpillar.
Okay, Matt, we'll wrap it up there. Thank you as always, sir.
Thanks, Roger.
Bloomberg's Matthew Griffin. And let's take one quick look here. Prime Minister Mark Carney is speaking at a news conference with the premiers at the closing of the First Ministers meeting in Ottawa. Our colleagues at CTV and CTV News Channel are taking that live and have all of that if you want to go catch that. That wraps up this edition of Trading Day. I'm Roger Peterson. Thank you very much for joining us. Have yourself a great day.